today, CPI at 6.9%, Numberwang strikes again. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, it's the last day of November today, and so we have data from both the RBA and APRA relating to credit, and we have data from the ABS relating to building and construction and building approvals, and also the latest monthly consumer price index. Now, that CPI, that is the new monthly series, rose 6.9% in the year to October 2022, according to the latest data from the ABS. However, despite the fact that all of the media coverage was celebrating the fall from 7.3%, the truth is a little bit different. The ABS said this month's annual movement of 6.9% is lower than the 7.3% movement in September. However, CPI inflation remains high. And the ABS notes that changes in CPI weights pushed down the figure from 7.1% to 6.9%. Now, actually, we think that should have been announced pre-release because, of course, the media just grabs the headline fall. They noted that the changes in CPI weights pushed down the figure from 7.1% to 6.9%, and that included significant adjustments relating to rent, for example, and also some other categories too. The biggest drops were actually seen in fruit and vegetables at 17.4% last month to 9.4% this, and holiday travel 12.6% last time and 3.7% this time. In fact, in October, the most significant contributors to the annual rise were new dwellings, up 20.4%, automotive fuel, up 11.8%, and fruit and vegetables, up 9.4%. And just to note that the trimmed mean was reported at 5.3%, which is a little bit lower than market expectations. But again, it's too soon to know whether this is a real thing or whether it's all in the noise. The Numberwangs, of course, continue to have a field day. High levels of building construction activity and ongoing shortages of labour and materials continue to drive higher prices for new dwellings. The rate of price growth in September and October eased compared to the highs seen earlier this year. In annual terms, new dwelling construction prices rose 20.4%, considerably higher than the increase for the 12 months to October 2021, which was 5%. Rent prices increased further this month from an annual increase of 2.9% in September to 3.5% in October, reflecting low vacancy rates. But as I said, the weighting was pulled down. Over the 12 months to October, the transport group rose 7.4%, with automotive fuel prices increasing to 11.8% in October. That's up from 10.1% in September. The full fuels excise tax was reinstated on the 29th of September, increasing from 22 cents per litre to 46 cents per litre, resulting in higher prices for automotive fuel. While automotive fuel prices remained elevated, the annual increase in October was actually well below the record increases seen earlier in 2022. So that means that automotive fuel prices increased 11.8% in the year to October, up from 10.1% in September. And food and non-alcoholic beverage prices eased from an annual rise of 9.6% in September to 8.9% in October. Improved growing conditions saw increased supply of fruit and vegetables, leading to lower prices in October compared to those seen in September. Annually, prices for fruit and vegetables rose by 9.4% in October, down from 17.4% in September. And holiday travel and accommodation prices moderated from an annual rise of 12.6% in September to 3.7% in October. Airfare prices eased as school holidays came to an end and lower demand for travel to Europe and America occurred during the off-peak tourist season. Now, about these weights. Each year, the ABS, they say, updates the expenditure weights applied to the CPI basket. This is important to ensure the CPI basket remains up to date and representative of current spending by households, particularly when capturing the changes to spending patterns since COVID-19. The update to weights in October saw several changes, the most significant being international travel, which increased from 0.1% in the CPI basket to 1.9%. Typically, annual updates to the weights have limited impact on the overall CPI, but this year, the significant changes in spending patterns over 2021-2022 meant that the reweight had a larger impact on the CPI than usual. The annual movement of the monthly CPI indicator in October using the previous weights would have been 7.1% compared to 6.9% using the new weights. So the point to make here is that really there is only a slight improvement in the inflation. This, of course, is the monthly series. The quarterly one will be the definitive ones. So let's not get overexcited about a slight movement in the numbers, particularly when the Numberwangs are at work. Now, elsewhere, the total number of dwellings approved fell 6% in October in Sydney-adjusted terms. That's following an 8.1% decrease in September. The ABS said the result was driven by private sector dwellings, excluding houses, which decreased 11.3%. Approvals for private sector houses fell 2.2%. Of course, the high-rise sector moves all over the place. It's very volatile. Across Australia, total dwelling approvals fell in New South Wales, down 18.8%, Queensland down 18.7%, and Tasmania down 10.5%, while South Australia at 17.6%, Victoria at 5.8%, and Western Australia at 5.7%, all recorded increases. Approvals for private sector houses were mixed, with Queensland down 13.8% and Western Australia down 0.4%. While Victoria was up 1.1%, New South Wales up 0.2%, and South Australia up 0.2% in October. And the value of total building approvals fell 0.2% in October, following a 7.1% decrease in September. The value of total residential building approved fell 2.1%, and that was a 2.7% decrease in new residential buildings and a 1.4% increase in alterations and additions. And the value of non-residential building approvals rose 2.6% after rising 6.9% in September. Now, the HIA commented on these numbers, saying that building approvals fell by 6% in the month of October, to be 9% lower than in the 3 months to October compared to the same quarter in 2021. The ABS released its monthly building approvals for October for detached houses and multi-units covering all states and territories. Despite the decline in approvals in recent months, they are yet to reflect the adverse impact of rate increases that commenced in May, they said. Building approvals have been sustained in recent months by the record number of home sales prior to the first increase in the cash rate that still haven't been approved, much less commenced construction. Sales in and financing of new homes have fallen significantly in recent months, but this is yet to flow through to the number of homes gaining council approval. The full impact of the rate rise will not be observed in approvals data until 2023, when the pool of earlier sales is exhausted. Building approvals for detached housing declined by 2.4% in October compared to the previous month, leaving them 11.8% lower for the 3 months to October 2021. Multi-unit approvals also declined in the month of October, down by 11.4%, though on a quarterly basis this is up by 13.9% on pre-pandemic levels. Affordability constraints in the detached market, combined with tight rental markets and returning overseas migrants, students and tourists, are set to support demand for more affordable, higher density living, they said. This means the multi-units market is set to continue strengthening in the face of higher interest rates and a cooling detached market. A large pipeline of home building work is sustaining employment across Australia and continues to obscure the impact of rising interest rates on demand for housing. The 2.75% increase in the cash rate will bring this pandemic boom to an end, but this is yet to be reflected in the approvals data, they said. In season-adjusted terms, total building approvals by state were mixed, with the declines led by Queensland down 22.1% in October compared to the same month in 2021. That was followed by Western Australia down 20.1% and New South Wales down 9.4%, with increases in South Australia up 18.8% and Victoria up 6%. In original terms, total building approvals doubled in the Northern Territories, up 104.5%, with declines in the ACT down 21.8% and Tasmania down 8.7%. And it's interesting to note that ANZ's economics have revised their forecast peak-to-trough decline in Australian home prices to 18%, with a recovery not expected until 2024. The decline in prices will be driven by reduced borrowing capacity following the RBA's aggressive interest rate hikes, they said. With our expectation that the cash rate will peak in May next year, we think that most of the impact on prices will be fully reflected by the end of 2023, ANZ said. In 2024, as policy stabilises and then eases late in the year, we expect to see a modest recovery begin to emerge in house prices and look for gains of around 5% by the end of 2024. Nationally, house prices are forecast to fall 7% this year and 11% in 2023. Sydney house prices are forecast to decline 12% this year and another 8% in 2023, whereas Melbourne prices are forecast to fall 8% in 2022 and another 9% next year. Brisbane house prices are forecast to decline only 1% this calendar year, followed by a 10% fall in 2023, whereas Perth values are forecast to rise 2% in 2022 before falling 13% next year. And it's worth noting, by the way, that Adelaide house prices are forecast to fall a whopping 21% in 2023, following a 9% increase this year. Now, of course, if ANZ's forecast were to come true, it would represent the biggest house price decline in Australia's modern history, easily eclipsing the record 2017-19 peak-to-trough correction of just over 10%. So now we should move on and look at the financial aggregates from the Reserve Bank, which were released today. And in summary, you can see that overall credit for housing was actually relatively strong at 9.5% in October 2022, that's year ending, compared with 5.7% in October 2021. Within that, housing credit grew 7.2% compared to 6.7% last year. Personal credit rose very slightly compared with a fall last year, and business credit rose 15% compared with 5.3% last year. And the broad money was 7.6% lower than the 8.2% last year. Now, on a monthly basis, housing credit was 0.4% compared with 0.5% last month. Personal credit was just slightly higher at 0.2% compared with being flat last month. And business credit was lower at 0.8% compared with 1.3% last month, while broad money increased up 0.7% this month compared with 0.1% last month. Now, if we look at the monthly series, the credit growth for housing overall was 0.44% in the month, and that comprised of 0.54% for owner occupation and 0.27% for investment. So you can see that everything's falling, investment is falling faster. And personal credit was up 0.21%. This is the start of an important trend, I think, because we're seeing more people using credit cards because they run out of savings, and therefore we expect more people to be in personal debt ahead. And business credit was at 0.83%, a considerable fall compared with the last 2 or 3 months. Overall, if you look at the aggregate data, all credit was 0.56% higher in the month, which is the lowest for some time, and broad money at 0.73% was higher than the last few months. Now, the more reliable annual series shows that housing growth is now at 7.19%, still very strong, but not as strong as previously. Within that, owner-occupied housing is growing at 7.66%, whereas investment property is at 6.23% and continuing to slide. Personal credit is up 0.26% over the last year, and you can see the considerable movement in the last 2 or 3 months. Business credit is at 15.03% over the last year, having been negative a year ago. And I guess some of that's the base effect, actually. Now, if we look then at the aggregate data, all credit for the year is 9.46% stronger, massively stronger, of course, than even inflation, let alone wage growth. whereas broad money at 7.57% is just slightly higher than last month. Now, I think the 3-month series actually gives us quite good insights too, and there housing is at 1.4% over the 3 months, owner-occupied housing 1.62%, and investment housing 0.99%. Personal credit up 0.53%, and business credit at 3.3% is lower than it's been the last couple of months. And looking at the aggregates, all credit up 2.02% over the last 3 months, continues to slide a little lower, of course. And overall broad money at 1.07% is somewhat lower than it's been recently. Now let's look at the APRA data, which of course is the stock data for the authorised deposit-taking institutions, or the banks. And this is again up to the end of October. So the first number to remember is just over $2.041 trillion in loans outstanding. That's yet another new record. And looking at the breakdown, you can see that both owner-occupied lending and investor lending continue to rise, although differentially, investment lending grew slower at 32.89% of all loans. And we can see the consistent trend since March 2019. Then the investment lending portfolio was 38%. Now it's down to 32.89%. Looking at the month-on-month change, owner-occupied lending overall amongst the banks was up 0.56%. Investment was at 0.2%, and total lending was 0.44%. A lot of that owner-occupied number relates to refinancing and, very importantly, equity withdrawal. Now it's worth looking at the selected portfolio movements from September to October. I've sorted this based on owner-occupied lending, and you can see that ANZ is leading the way, followed by CBA. That's quite significant. ANZ, up till quite recently, was losing share. Now they've turned that around, partly because of the very strong incentives that they're offering people to currently go with them. Westpac and National Australia Bank were down quite considerably, and Macquarie continues to write the largest proportion of investment loans. Amongst the smaller lenders, AMP is quite strong. I think that is explained partly by their big drive to capture deposits. They've been offering some of the best deposit rates in the market recently, whereas Bendigo and Adelaide Bank is going the other way. And Suncorp is writing investment lending more than owner-occupied lending. And interestingly, both the Bank of Queensland, ING and HSBC are seeing their total portfolios weakening. So what to make of all this? Well, the truth is that the numbers, of course, are all over the place. We are seeing credit lending ease back, but of course it's being supported by very strong refinancing of existing loans as people try to jump on the bandwagon of reducing their interest rates. We're going to get data from the ABS soon on that. The other observation is that the CPI numbers are down very slightly, but most of that statistical anomalies rather than real changes. And the monthly one, of course, is not really that robust anyway. So we'll see what the quarterly result is later on. And finally, with building approvals, as expected, we are continuing to see weakness here. Although, as the HIA said, there's a hangover simply because of the backlog that already has been approved. And there's more to come. But eventually, it's going to ease back too. So net-net, I would take this information as further confirmation of a slowdown, economically speaking, in Australia over the next few months. Not a strong one necessarily, but possibly enough to challenge the RBA not to go more than 25 basis points next week. And then, of course, they'll be away until February. So if they go 50, that will be a surprise and would suggest that they are more concerned about the real impact of inflation. Of course, they keep saying they are, but in fact, in practice, their actions speak a different language. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.